Hello, my name is Ian Slattery from the team at Zurich Investments. Firstly, I'd like to thank Alan and the rest of the team at MBC Financial for giving me the opportunity to speak with you today. As we embark on another year of investing, it's always an opportune time to take a look back at the year just gone by, but also to look forward and to see what we might have to expect for 2022. So I'm going to start sharing my screen where I'll just go through a few of the key points that myself and my colleagues at Zurich Investment are looking at the moment, and I should have be all done and dusted in about 10 minutes. Firstly, as we look to 2021, it was overall a positive year for stock markets. This is the performance of global equities throughout 2021, and whilst there are some dips and ups and downs along the way, as we might expect for equity investment, overall a positive picture with the stock markets finishing the year up in and around 25 to 30%, depending on your fund. As we always expect with equities, there were some falls throughout the years, but not as severe as we've seen in years gone by. And the majority of any of the dips that we saw in 2021 were in and around inflation expectations and the potential for subsequent policymaker action. That lovely 45-degree angle that we would love to see every year was certainly there in 2021. It was a banner year for equities. So equity investors or people in multi-asset funds that are predominantly equity based hopefully will have enjoyed a good year, as all our funds within Zurich Life did. If we look a little bit or delve a little bit deeper under the surface and look at the different sectors or the different business areas in the stock market, it was a green across the board, ranging from utilities up 19%, all the way up to energy up 52%, albeit energy coming off a relatively low base after some falls in 2020. Whilst the likes of consumer staples and utilities did lag the overall market, even in absolute terms, returns of 22 and 19% respectively are still really, really positive. And we saw all the different equity areas of the stock market contribute to this global stock market return of approximately 31% for the calendar year. At Zurich, we've identified some of the key potential reasons of why we saw such positive returns for equities in 2021. I think the first thing to say is we do have a supportive policymaker backdrop. On one hand, we have monetary policy, so think about central banks, quantitative easing, interest rates. And on the other hand, we have fiscal policy, so think about government spending, government supports, for example, PUT payments, and its similar programs throughout the developed world in particular. So the policymaker backdrop was certainly a supportive one for equity investors and risk assets in general. I think it's fair to say that the vaccine rollout and its subsequent booster program both stumbled a little bit at their outset, but they did really ramp up both in terms of the speed and the scale here in Ireland and throughout the developed world as well. And that kind of fueled consumer confidence, company or firm confidence as well, and gave an optimistic backdrop and led to higher economic growth, which manifests itself into higher equity prices as well, or equity returns. COVID fears in general did subside throughout the year. If you think back to that first slide I had, the calendar year graph, the only time that I suppose COVID really hit equity markets was the emergence of the Omicron variant in December. And even after that, stock markets did recover quite quickly in a V shape and proved their resilience to finish the year close to a record high. Whilst COVID still dominates our professional, our personal, and our social lives, it's becoming less and less of a narrative or a theme that equity markets are reacting to on a daily basis. That doesn't mean it won't change in the future, but COVID fears, I suppose, on balance, have subsided throughout 2021. There's also this concept of pent-up demand, that a certain cohort of the population have been lucky enough to be able to have excess savings and put a little bit of extra away each month throughout the pandemic by virtue from working at home and not being able to socialize or go on holidays or whatever it might be. That pent-up demand has begun to be released, which leads to kind of higher earnings for companies as people spend more, and that obviously translates into the profits, and that translates into equity prices as well. So some of the key points that Zurich has identified for why we saw such a strong return in 2021. I mentioned that supportive policymaker backdrop, and what I have on this slide is just I suppose the evolution of interest rates, or the key interest rates, across the 5 main central bank regimes globally. If we look at the US in the blue line, really responded very quickly with a drop of interest rates in February, March, and into the second quarter of 2020. But all five of the key rates remain at very, very low levels. Whilst the Bank of England in the UK did increase its interest rates in December, we do see a supportive policymaker backdrop in terms of accommodative interest rate policy persist in the main central bank jurisdictions globally. A consequence of that is that we do see cheaper credit for companies. We see flows into equities as a result, and that loose monetary backdrop has helped equities and risk assets such as commodities in 2021. However, it also has other consequences, and I look at inflation. I mentioned inflation as a key theme or narrative throughout 2021, and we suspect that will continue into 2022 as well. What I have on this particular chart is the developed world or advanced economies in the blue line and emerging markets in the red line. You can see both of them pretty stable for the first 4 out of 5 years on this particular chart, before both shooting up in 2021. And we see inflation in some regions, for example, in Europe, at the highest level in decades. And as I speak to you now on the 12th of January, we've already seen in 2022 how inflation expectations and the potential for a subsequent policy reaction from central banks has created quite a few headlines already. If we look at some other maybe potential opportunities and risks that could emerge this year, and we look at the Federal Reserve and the Biden administration as the dominant monetary and fiscal policymakers globally, if they manage to exceed investor expectations and keep the global economy on an even keel, we could see global growth move higher and surpass COVID or pre-COVID levels. And again, if that was to materialize, we could see inflation subside. However, in terms of risks, I think we've already spoken about inflation. It could well persist at higher levels. That would lead to a more severe or potentially a more harsh policy, or at least perceived policymaker response. I think geopolitical fears, if we look at, say, the potential for a clash between the US and Russia and Ukraine, or the US and China and Taiwan, whilst we don't believe they're base cases and they don't dominate our thinking, it's certainly prudent to be aware of them. But overall, when we balance up the opportunities and risks at the moment, we do believe that the positive trend for equities does persist. Also, when we look at relative valuations, so we look at equities versus other asset classes, we do believe equities do offer the best relative value versus the other options out there. That leads us to maintain a higher equity allocation than average. So our equity allocations across our multi-asset funds are above average or above the midpoint. Within our equity book, we do have a preference for the Eurozone, the UK, and parts of Asia, and particularly Japan, whilst we are a little bit more underweight to the US stock market at the moment. However, the US stock market is still the most dominant on the global basis. Within fixed income, we do have a preference for corporate credit over government bonds. Our outlook for government or sovereign bonds is quite cautious at the moment, given what we think might happen in and around inflation and subsequently interest rates at the moment. So again, lots of opportunities and risks out there for 2022. However, I always think it's important to think about some investment principles that have stood or do stand the test of time. And I know Alan and the team at MBC will have discussed some of these concepts in your meetings and calls and video calls over the last number of months and years. I think it's important to have a financial plan, to stick with it, to stay disciplined, but also to acknowledge that volatility is part of investing. And over the long term, we know that patient investors, that risk is rewarded, and time in the market is also very, very important. It's always worth reminding ourselves of some of those investment principles, particularly if we have a bit of a bumpy road ahead, or we see above average volatility materialize in risk assets or within stock markets in particular. So thank you for your time today, and thank you for everyone at the team at MBC, and particularly Alan for inviting me and giving me the opportunity to speak with you today. From everyone at the team at Zurich Investments, I wish you well for the year ahead. And if you do have any questions, please do get in touch with myself or Alan, and we'll be sure to help you out with any queries you might have. But that's all from me today. Thank you very much, and best of luck for the year ahead.